Welcome to Killick & Co.'s podcast for the 9th of December. Last week we saw equity markets fall, particularly Monday, Tuesday and part of Wednesday. This was interesting just merely for the fact that as we enter into December, for the last 10 years, December has always produced a positive return for the FTSE 100. So could this be the year that this will be different? Certainly this year we've had positive returns across global stock markets ranging from north of 50% returns in the Japan's Nikkei index to around 10% or so on the FTSE 100. Having had a rather poor start, the market did turn and put in a more positive second half of the week. This was driven on quite a big revision to the US GDP number. It was a second reading of Q3, and that was upgraded from 3.2 to 3.8% on an annualised basis. And on Friday, we also had the non-farm payroll data, with the number coming in just north of 200,000 against a consensus of 180,000. We also heard from the Bank of England with their interest rate decision, and we also heard from Mario Draghi and the ECB on Thursday, again leaving rates unchanged there. In the press conference after, it was quite clear that he wasn't coming up with any particularly new initiative, but attention will turn to the inflation data that's coming up as decides whether he should be looking at a second LTRO programme. So let's just turn to the week ahead and just really focusing on what is generally a quieter week for markets. Germany's CPI on Tuesday, as I say, this inflation data starting to come through with the monthly statement from the ECB on Wednesday. In terms of stocks, again, the corporate reporting season is starting to wind down ahead of Christmas. We'll be watching out for Imagination Technologies, which is due to report its results on Wednesday. Half one interim results are due out at start of play on Wednesday. On Friday, we also have results out from Bellway in the house building sector, and we'll comment a little bit on Berkeley Group. Now, Berkeley is a company that recently featured on our buy list. It certainly fitted into the category of an income producer, and the interim results last week demonstrated they've increased the interim dividend from 15 pence to 90 pence and gave just a little bit more clarity to 2014 and 2015 ambitions with regards to capital investment, capital return, which may come in the form of enhanced dividends. So that was good enough to send the stock price up very sharply on Friday and taking Berkeley Group to a new high of around just over £25 a share. In terms of other stocks that are in the news, well, we're keeping an eye on HSBC. This also made it onto our list of stocks or top recommendations for 2014. The shares are drifting back towards the low end of their trading range for 2013, at which level the dividend yield is north of 5%. And there's a story that featured over the weekend and has given the stock a little bit of a lift on Monday morning relating to a possible listing of the UK business into the London stock market, a trend that some analysts are talking about as really just in light of the enhanced capital requirements for banks around the globe, that this may be an initiative to crystallise more value for the banking stocks. So just maybe an interesting one to watch, particularly given that the shares are on the low. They were additionally hit last week by quite a poor trading update from Standard Chartered, which saw its share price come off close to around 10%. In terms of currencies, I think it's worth just observing that the euro is trading sort of back up towards its highs of 137, did temporarily break through 138 back in October, and you may recall that was the time they imposed that rather surprise quarter-point rate cut in Europe, and really specifically mentioning the strength of the euro as proving to be difficult at the moment to get inflation moving. Inflation, as we know, has been drifting down to sub 1% across the European region and is a cause of concern. So I think this sort of further move up in the euro really coming on the back, as I mentioned earlier, of a lack of sort of any new initiatives from the ECB to address this issue. So feeling just a little bit more hawkish than dovish in tone, leading to that strength, may well come home to cause some concern within the ECB over the course of the coming weeks. So just one to keep an eye on is that euro-dollar exchange rate. I mentioned Imagination Technologies, really just to highlight that the stock has had a difficult past 6 months. There has been some concerns over competition issues with ARM, and we'll be looking at the interim results on Wednesday to give some clarity over current trading within that company. Japan continues to excite us. The stock market in Japan closing up around 2.3% overnight, and is come perilously close to the all-time high, year high for the Nikkei, just around 15,750, so we're about 100 points shy. I suspect it will probably try and take that top out over the course of the next couple of weeks. A really continued focus there is on the weakening of the yen, which is nudging 103 against the dollar, and that sort of resumption of yen weakness is driving the big international stocks and the Japan's Nikkei higher, and that has proved to be the market of choice for 2013. But important to note that really the gains that we've seen there have largely reflected the corporate earnings rather than any expansion in the price earnings ratio that's being applied to it, which is unlike what has happened certainly in the US markets over that time. So there feels to be just a little bit more substance to the rally in Japan going into 2014. Finally, just a couple of the sort of major market charts. Euro stocks was a material underperformer last week, coming off compared to, say, the US stock markets. And finally, the FTSE 100, it's really trading around 65.50 at the moment, posting gains of around 10%. So again, an underperformer against even Europe and the US. But we'll be interested to see how this trades into the last 2 weeks, and say whether it can continue up that sort of 10-year track record of positive returns for December, or whether this is the year that's going to make a break.